Fintech is back, baby, and back office sources of truth are converging. Yo, welcome back to another State of the Private Markets report. Today, we're breaking down the biggest private market stories and not just what happened, but why it matters if you're trying to position your company for the highest possible valuation. I hate when people just give me interesting information, but they don't tell me why it's important. But first, I'm reading it right. We have a sponsor. It's NetSuite, and they paid for the couch next to me for my dog. That is the true meaning of wealth in this world. You don't have to have a ton of money. You just have to have enough money to buy a couch for your dog so he can stare into your soul as you do a podcast by yourself. Thank you, Walter. What does the future hold for business? Ask 9 experts and you'll get 10 answers. Bull market, bear market, rates will rise or fall. Can someone please invent a crystal ball? Until then, over 41,000 businesses have future-proofed their companies with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. Whether you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. And let's be real, guys, NetSuite is the gold standard for ERPs. I love NetSuite. It's what I use. I'd recommend it as well. Whether your company's earning millions or even hundreds of millions, that would be sick. NetSuite helps you respond to immediate challenges and seize your biggest opportunities. I think you should download this guide. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/metrics. The guide is free to you at netsuite.com/metrics. netsuite.com/metrics. So I can buy my dog another couch. First story. Stripe's valuation jumped to $85 billion. Woo! So Stripe is arranging an employee tender. Pretty nice of them, allowing employees to take a little bit of those chips off the table. It would value the company at $85 billion, up from $70 billion, its latest mark last summer. Now, if you look at their revenue, I checked it on position.so, and they're at about $4 billion and growing in the high teens to low 20s. So quick math would put them at about a 20x forward revenue multiple if you extrapolate that out, which makes sense given that they have this moat of infrastructure that they've amortized over time, which is a fancy word for paid down. They have this high margin software plus payments revenue, and it's really sticky. And the fact that investors still see them as a dominant private fintech, right? If you want to get a little bit of those tendies in the private market in payments, you're probably going to go to Stripe. Now, let's compare that to Mercury. Congrats on their latest round at a $3 billion valuation on a reported $500 million in revenue. And they're wicked profitable. $200 million in EBITDA. That's crazy. 200 on 500. So that's roughly a 6x current revenue multiple, which is notably lower than Stripe's multiple, which made me go down this rabbit hole, everyone, on what makes a fintech valuable. How the hell did they come up with these valuations? And not all fintech revenue is valued equally. So you have the payments flow revenue, which receives pretty high multiples. So you have Stripe and Brex. They're either in online payments, corporate cards, they fall into this camp, and they take a clip of every transaction, right? That's their modus operandi. And that makes the revenue more predictable. It's more about how much throughput you have versus interest rates. Mercury earns a big chunk from interest on deposits. So that'll receive a lower multiple because it's so tied to macro factors like Fed rates. So investors will discount it. So to talk a bit more about fintechs and how they're valued, I want to hit on Chime and Klarna, who are making waves in the news. Who will get a better multiple? Time will tell. And it's important to note up front that basically the department that says like, hey, that's not good for consumers. This is good for consumers. Payday loans, be careful. Like the Financial Bureau Protection Agency, which I'm probably butchering the name, but like those acronyms are getting really long. They were disbanded by that other acronym group, the Doge Group. And basically what it means is it's easier to have more creative business models with lending and financial products. So this is a massive tailwind for Chime and Klarna. They're probably like, hell yeah, it's going to be easier for us to IPO because our story of where our revenue will go over time is less weighed down by what may happen with the government and the regulations that are slapped on us. Because if you remember, the government will, have a heavy hand when something looks pretty risky and is going to harm consumers. And then what happens is the companies end up having to pay for that in some way because your consumer's risk is essentially your risk, right? So Chime has this neobank model where the revenue comes from interchange fees, mostly debit cards, and some lending because you can get paid faster. And Matthew Newcomb, amazing guest to the Run the Numbers podcast, CFO there. He's running this company at scale that was valued at a rumored 25 billion. Woo! They're expected to garner a valuation probably in like the 5x forward revenue range, but it could get squeezed if that department did spring back up again. But like I said, right now, all signs point to go. And then Klarna, they run a buy now, pay later model. So that's a different fintech model. And they make money from merchant fees plus consumer lending. Their target valuation is somewhere in the 15 to 20 billion, which will be a massive rebound from the 6.7 billion I see on position.so that they're trading at back in 2022. You remember in 2021, they went all the way up to a peak of 46 billion. That'll make you spit out your iced coffee. 46 billion. The key risk for them, buy now, pay later, defaults, right? Could this be a true payments business or just a subprime lending, business in disguise? For you to decide. But who wants to pay for a Peloton now? I certainly don't. Maybe the Peloton treadmill would look good in this office. We already have the sofa. Affirm, just to link this to the public markets, because part of my job is to help you translate the macro to the micro. Affirm's comeback is really astounding here. They're one of the highest traded fintech companies when it comes to revenue multiples. They're over 7x as of this week. And they're probably the closest comp to Klarna, if you want a comp. Their stock is up big in 2025. It's hit $79 at its peak, way up from, I think it was at like $8 a share, $9 a share in 2022. They did that brave thing where they went out and IPO'd like as the IPO market was freezing up, and they got beat up for it. But they've done an amazing job at building a durable business. Michael Linford, also a friend of the Run the Numbers podcast. Check out that episode. He crushed it. Their stock is up big, and their revenue surged to 866 million last quarter, up 47% year over year. That's nutty growth, right? And so they're on track for GAAP profitability by late 2025, which is a big deal at fintech because we talked about amortizing down your costs before. At scale, these businesses absolutely rip and print cash, like Mercury is doing. Congrats to Mercury. So if a firm can prove that buy now, pay later works at scale, that's an awesome omen for Klarna, who benefits from stronger IPO demand. But if Klarna can't show cost control and profitability, which was a major worry and why their stock tanked when everyone was like, oh no, we want efficient growth, then yeah, investors won't bite. Bottom line, buy now, pay later is back, but Klarna still has to prove it's not just a boom and bust model. Maybe we'll see later in 2025 when they hit the public markets. One other story I wanted to hit on here because it's relevant to CFOs. HiBob acquired Mosaic. So is HR becoming an ERP? So this isn't just another HR tech acquisition. In my opinion, it signals a bigger shift in how back office software is evolving. So HiBob and HRIS, they bought Mosaic, an FP&A tool, so budgeting tool. And I think it suggests we're heading towards this world where HR and finance converge, similar to what's already happened with some of the ERP tools out there, especially around like close management. So HR and finance are becoming a single system in many ways. Payroll, expenses, headcount planning, they're deeply tied to financial forecasting. And at software companies, I mean, like 75% of the costs walk on 2 feet. So why wouldn't you want them in the same place, right? And companies don't want 10 different tools anymore. They want one source of truth. There's been this proliferation of all these point solutions out there. I think what we're seeing is the pendulum is swinging in the other way. And Workday saw this early. They acquired Adaptive Insights, another FP&A tool, back in 2018 to move from just HR into financial planning. And now they're basically building their own enterprise ERP. They've built something amazing there. And I think it takes a page out of SAP's playbook, right? They already did this at scale with HR and a finance stack that's been around for years, proving that the model works in the enterprise. But now what I find fascinating is it's happening amongst SMBs and mid-markets because HiBob, that's really where they play. If you're like a company with 200 to 500 employees, it's perfect for you. And now you have an FP&A solution as well. So what's next? I think if you're a CFO or somebody evaluating tools, expect more consolidation in the HR and finance stack. Really look from who you're buying from. And standalone FP&A tools, I'm wondering if like a Cube or a Pigment, not that they'll get squeezed, they can actually go the other way and maybe work with an HR vendor. Maybe they'll even create their own. I don't know. But yeah, the mid-market doesn't need a full-blown NetSuite or SAP from the very start. People are going to NetSuite sooner and sooner. Sponsor the podcast, bought that sofa. But they do need a modern ERP Lite that combines HR and finance. So Hi Bob is making a bet that HR will be the entry point to owning the entire back office. And if they're right, more HR platforms could start absorbing finance tools instead of the other way around. So some final thoughts here. Fintech is back. Valuations are shifting. Back office software is consolidating into these mini ERPs. And so if you're a founder in these spaces, knowing how investors value your revenue model is critical. Pay attention to other comps that are out there. Are you more like Stripe? Are you more like Brex? Are you more like Mercury if you're a fintech? And are you dealing with credit risk? Because that'll be factored in to your valuation multiple as well. Your multiple depends on it. Please give us 5 stars. I will buy you a beer. You know, as Vin Diesel says, you can have any beer you want as long as it's a Corona. As long as it's a Miller Lite, I'll buy you a beer. Next time we meet in person, just remind me, I'm good for it. I promise. Till next time.